I don't even know where to start here, Chris. I mean, this was a pretty wild week with a lot of different catalysts here. What do you think was most important for you in terms of getting a better read on what's going to happen next?
Romaine, it's all about earnings. It's got to be about earnings. Those are fundamentals. They still matter. And I said to my board this week, we had an offsite. Rule number one is don't fight the Fed. We all know that. But rule number two, don't fight the tape. And the tape and earnings are saying that this market is okay. It's surprising to me, but we're still okay.
And you're fine with okay? Or more importantly, do you think investors are going to be fine with just okay?
Well, when you look back at my fiscal year, just into June 30, you've got U.S. stocks up almost 19%. That's a bull market. That's fantastic. So we still anticipate a recession, but you've got really strong earnings and you've got returns coming out of equities.
Do you anticipate a recession this year, or is that being kicked down into 2024 or beyond?
All right, Romaine, you got me. I'm embarrassed, I admit. I still think there's about a 50-50 chance we have a recession somewhere in the next two quarters. I've been saying that for a year, and I've been flat out wrong. But obviously, as you've been saying, there's a growing chorus of people believing the Fed is pulling off a soft landing. Inflation from the numbers this week are lowering in the 3% range, and that may be good enough.
So part of why everyone is still convinced that there is going to be some kind of slowdown or possibly a recession is because we've had 525 basis points hikes in rates, and at some point that's going to show up in the economy. From where you sit, what kinds of companies or which parts of the economy are feeling the pain the most?
You know, Scarlett, and I've been saying that for a while, when rates climb 550, somebody's got to get hurt. And, you know, my investment committee chair told me the other day, he believes Jay Powell, he takes him at his word. Why doesn't the street seem to believe him? Normally, we'd expect the real estate stocks to be hurt, and then obviously medium-sized financials. We'd expect the consumer to start showing some pain, but they're not. So it's still surprising. You are seeing some pain points, obviously, in real estate with some of the mortgages. Big players putting buildings back and a draw on the real estate REITs. But, you know, we're not seeing the pain we would expect at 500 basis points.
Yeah, it might be a slower, more drawn-out process. In the meantime, we were talking earlier, Chris, about the BOJ perhaps tilting more hawkishly. This idea that the Bank of Japan is getting slightly more hawkish does signal a new era for central banks. What does it mean for investors like you?
We've got to pay attention to central banks. We're a global portfolio. So first and foremost, we watch the Fed because the vast majority of our portfolio is here in the USA. But we've got to watch the ECB, the BOJ, and then a little bit of the Bank of England. And for the last couple of years, we have really seen coordinated responses. Think back to the beginning of this pandemic in 2000. Absolute coordinated response in March of 2020. And then now they've really all been trying to fight inflation. So the rule of don't fight the Fed stands whether it is a central bank in the U.S. or anywhere. Pay attention to central banks and the flow of interest rates. I always say, as much as equity people think they're the first and foremost, it's really the bond market you've got to pay attention to. And bonds are telling you there's still an inverted curve and there's a risk of a recession.
And you're certainly not alone in that call, Chris. I mean, we've talked to some people here on this program who've said just that. Don't get too complacent because there are still some red flags out there. When it comes to your own allocations and with the asterisk, the caveat that you are probably one of the longest of the long-term investors out there, do you sort of reposition, if at all, if you expect that economic conditions are going to deteriorate?
Well, I would say yes, Romaine, but, you know, if you did too early, like last year, then if you were defensive, which we were for part of the year, it hurt your performance. So we, frankly, have been taking profits as this equity market continues to run, and we are beginning to feather back into fixed income. We see that as an increasing opportunity and a great place to be, both in some of the credit opportunities and then even in the straight sovereign debt. So we're finally earning a rate of return, 4 to 5% coupon income out of fixed income. That's a good thing, and we'll take that when we get it.
When it comes to corporate fixed income here, are you primarily sticking with, I guess, high-quality borrowers?
You really do have to pay attention to your credit as always. And yes, high quality borrowers. It's not a time where you're going to want to take a ton of risk in high yield, but they're even there. There's some opportunities. It really gets back to whether you're trying to be a trader in fixed income or an investor. I think traders have seen themselves get hurt by this yield curve moving back and forth rapidly as the central banks take action. But to investors, there's opportunities to pick off and hold yields to maturity. Howard Marks wrote a great article a couple of months ago about just time to look back at fixed income.
Yeah, well, one final question for you, Chris. With central banks, as you say, moving together, tightening their policy together, are treasuries still the preferred flight to quality security, or has something else, or will something else take its place?
You know, Scarlett, great question, because we thought in '08 we were going to see other securities besides the dollar. I mean, our budget deficit's growing huge, and obviously the Congress doesn't deal with the deficit very well. But surprisingly, it is still the U.S. 30-year bond. It is still the key flight to quality. And a lot of us, U.S. and non-U.S. pension plans use that as a nice defensive area to protect our portfolios.